Index funds and ETFs. If you've spent any time researching how to invest, you've run into both of these. And if you're like most people, you've probably wondered, are these actually different? And if so, which one should I be using? The honest answer: for most long-term investors, the difference is smaller than the financial media makes it sound. But there are real distinctions, especially when it comes to taxes, that are worth understanding before you put money to work. That's what we're covering today. Let's start with index funds. An index fund is a type of mutual fund designed to replicate the performance of a specific market index, like the S&P 500, the total US stock market, or a bond index. The fund buys and holds all, or a representative sample, of the securities in that index. It's passively managed. The fund manager's job isn't to pick winners, it's to mirror the index as closely as possible. If the S&P 500 is up 12% in a year, a well-run S&P 500 index fund should return close to that, minus a small expense ratio. Index funds are priced once a day, after the market closes. Every order placed that day, buy or sell, executes at that single end-of-day price. Now ETFs, exchange-traded funds. Most ETFs are also passively managed and track a specific index, so in that sense, they're similar to index funds. The difference is structural. ETFs trade on a stock exchange throughout the day, just like individual stocks. Their price fluctuates in real time based on supply and demand during market hours. You buy and sell ETF shares through a brokerage account at whatever the market price is at that moment, not at an end-of-day price. So, both index funds and most ETFs track indexes. The difference is in how they're priced and traded. That distinction has some meaningful downstream effects, which is what the rest of this video is about. There are 4 differences worth understanding. Let's run through them. First, trading flexibility. Index funds are priced once a day. Every order that comes in executes at the closing price. ETFs trade in real time. For most long-term investors, this distinction doesn't matter much day to day. But for strategies like tax loss harvesting, where execution timing has real tax implications, the intraday flexibility of ETFs is a genuine advantage. Second, minimum investment requirements. Many index funds require $1,000 to $3,000 or more to get started. ETFs have no minimum. You can buy a single share, or even fractional shares through most major brokers. That makes them more accessible if you're just getting started or building a portfolio incrementally. Third, cost. Both are known for being low cost relative to actively managed funds. ETFs historically had trading commissions on top of their expense ratios, but most major brokers have moved to commission-free trading, so this gap has largely closed. Fourth, and this one matters most if you have a taxable brokerage account, tax efficiency. This one deserves its own explanation. This is the one that surprises people, so pay attention here. When you sell ETF shares, you're generally trading with another investor on the open market. The ETF itself doesn't need to sell the underlying stocks or bonds to give you your money. That means no taxable event inside the fund. Index mutual funds work differently. When investors redeem their shares, the fund often has to sell underlying securities to raise the cash. Those sales can generate capital gains, which get distributed to all remaining shareholders, including you, even if you didn't sell anything and didn't ask for a distribution. In a taxable brokerage account, that matters. You could end up with a tax bill from gains you didn't realize in a year you didn't sell. ETFs largely eliminate that risk through the way they're structured. One important caveat: in a tax-advantaged account, your 401k, IRA, or Roth, this difference disappears entirely. Gains inside those accounts aren't taxed as you go, so the tax efficiency advantage of ETFs is only relevant in a taxable account. Let's put the pros and cons side by side. Index funds. The pros are simplicity, automatic dividend reinvestment, and the fact that they're the default in most 401k plans, where the ETF tax advantage doesn't apply anyway. The cons are lower tax efficiency in taxable accounts, minimum investment requirements, and once daily pricing. ETFs. The pros are better tax efficiency in taxable accounts, no minimums, and intraday trading flexibility. The cons are worth knowing too. There are bid-ask spreads, a small gap between the buy and sell price. For large, liquid ETFs like an S&P 500 fund, this is negligible. For smaller, less liquid ETFs, it can add up. And because ETFs trade like stocks throughout the day, they can tempt reactive decisions in a way that index funds, priced once at close, simply don't. So which one is right for you? Honestly, it depends less on which vehicle and more on where you're investing. In your 401k or any employer retirement plan, you'll almost certainly be using index funds. That's what most plans offer. And that's completely fine. The tax efficiency advantage of ETFs doesn't apply inside a 401k. Maximize your contributions here before worrying about fund structure. In a taxable brokerage account, ETFs generally have the edge. The tax efficiency advantage is real and meaningful here, especially over a long time horizon. Broad market ETFs with low expense ratios are a natural fit. If you're just getting started with a smaller amount, ETFs are more accessible, no minimums, fractional shares available at most brokers. You don't need $3,000 to get in. And if you want pure simplicity, automatic dividend reinvestment, no thinking about bid-ask spreads or intraday prices, index funds are hard to beat. Especially inside a Roth IRA or traditional IRA, where the tax dynamics are already taken care of. Here's the summary. For most long-term investors, the differences between a well-chosen index fund and a comparable ETF tracking the same index are relatively minor. Both deliver broad diversification at low cost, and both are far superior to actively managed funds for most investors over time. 4 things to take away. In a 401k, use what the plan gives you. Index funds are completely fine. In a taxable account, ETFs have a meaningful tax efficiency edge worth taking advantage of. But both beat active management, low cost and diversification are what move the needle over time. And the vehicle is secondary. Your asset allocation, how you're spread across stocks, bonds, and other assets, is what drives long-term returns. Getting that right matters far more than index fund versus ETF. If this was helpful, the full guide is linked in the description. It goes deeper on expense ratios, specific fund comparisons, and how to think about structuring your portfolio across account types. If you haven't subscribed yet, we put out a new financial guide every week, practical stuff for people building long-term wealth on a W-2 income.